right now, everyone is paying attention to what's happening to America, and especially if someone is interested in finance, you cannot ignore the American Stock Exchange. But one thing is, those are equities. Equities, or the stock market, where you buy shares into the company, they have the potential to even go 100% in 1 year. We saw in the last 18 months, people who bought Nvidia, that has been riding the wave of AI, artificial intelligence, that the company at one point it was as low as valued by 100 billion, and in just a space of 18 months, it is reaching what? 3 trillion, one of the most valuable companies. Why? Stocks and equities are like that. But because they have the potential to rise exponentially, they also have the potential to come down, depending on the waves. People who follow on Twitter, X, which we call now Twitter, in the last year, of course, they know the owner right now, Musk. Elon Musk in Tesla in 2024, close to the end of 2024, the price of Tesla was around $400 for a share. Right now, it's below 250. So when you have to make investments and you want to target equities, understand that they can make you money exponentially, and the people who trade into them, they even trade the options. I have a friend of mine, Jean, who is very good at options. One of the things is they study the market. They know when to enter, they know when to exit. So for those, I tell people, until you understand the market and how it works and the fundamentals of specific companies, then equities might not be the best option for you, because they swing up and down by anything. There are some companies where a CFO or a CEO falls sick, and all of a sudden that has an impact on the price movement. So in the US, it has been the tariffs and the movement of that, the politics of the day by the new administration, and it's impacting the stock market. But those are equities. So alternatively, when you, especially for us who are mostly focused in Uganda, there are other companies you can buy in. Actually, for them, they bear a move, but they are very good. They call them the black diamonds on the Ugandan Stock Exchange. We have MTN, Uganda. We have Stanbic, Uganda. We have, I also these days add on DFCU. Its fundamentals look good as a banker, as a commercial bank. Its holding company is listed. That company is a very good buy, right? Then you have the price of Corite Chemicals right now seems it's a good point to enter. Then we have the Umeme thing that has just gone on, but the last few years it has been a black diamond, paying significant amount of dividends to its shareholders. Then you have Airtel Uganda, where it is right now, it's a good place to enter. So even in Uganda, there are stocks that you can buy, but you have to enter them knowing that the price can come down, but also can go up. We have seen a more than, I had forgotten another very good company for my very good friend, Bank of Baroda. Very good company. It's a bank, it's a commercial bank. It's paying a very good dividend this year. It's doubling the dividend to their shareholders than what it contributed last year. But that means all of a sudden there we are talking about a different product. Its risks and analysis are different. When you're talking about treasury bonds, that's a fixed income. We call them fixed income investments. If you buy a 10-year bond that guarantees you 14% return, it's not going to give you 20, it will give you 14. But the good thing is it will never give you also 6%, because that contract is done and signed. For the next 15 years, you're going to get 15%. However, especially if you're an investor. However, there is something that impacts treasury bonds. Maybe I should also explain this very well. When you come to treasury bonds and you buy your bond right now, let's say when it's the interest rate at 16%, in 3 years, if interest rates go down, your bond increases in value. That means the bond you bought at 1 million, in 3 years, when interest rates go down, the bond will become maybe 1.1 million, right? The alternative is true. If you buy a bond right now when interest rates are 16%, and it's a 10-year bond, a 15-year bond. And in 3-5 years down the road, the bond interest rates, we get a hyperinflation situation. Interest rates go up at by 20-25%. Then the value of your bond goes down, especially if you want to sell it. That means the bond you bought for 1 million now all of a sudden might be worth 900,000. But however, the good thing, the next 3-4 years it has been giving you a coupon. So even at the time when the value goes down, you have been earning a profit out of it. So you are not just necessarily making a loss. You have got value out of your bond. So these two products, they are interchangeable, but they are good. You have to understand what risk do I want to take. The risk of fixed income is that you lock in a fixed rate for a long term. In Ugandan basis, 14% is good, 15% is good. In the US, treasury bonds are offering, 10-year bonds are offering around 4.3%. In Uganda, we are looking at 14%. But then there is also, you have to look at the FX. That's if you have capacity to invest in the US. The stock market, in the US, the stock market is volatile. It's responsive to any news. Good news will make the thing go up. There is one of the companies that I'm invested in, Palantir. Last week, it announced that they are opening up a fellowship program for the best and the brightest engineering student. That's all they announced this week. And it's the company this week that has made the most money. Their shares are going up when everything is going down by just announcing that. Yes, all the other fundamentals are very good in this company. But just that they are going to do a fellowship program that they want to do that can compete with universities to train engineers, then it automatically flows into their share price because all of a sudden there are investors who are going to get attracted with that. That's not the same for fixed income. Fixed income, when you make the investment, you have locked in the good deal. However, the downside of fixed income like treasury bond is in a few years down the road, if interest rates go up, the value of your bond will come down, especially if you want to sell. If you do not want to sell and you hold it till maturity, when it expires, there is no problem whatsoever. And we are encouraging people to come into this from an investment perspective. Buy, hold it, keep buying every time. Now, when you keep buying and you enter the market to do those transactions, every time interest rates go up or go down, you are good to go because you know I'm not impacted by the circumstances of the day.